Welcome back to Weekly. I'm chatting real estate with Andrew Moffs of Vision Capital. So before the break, I teased our viewers that we're going to talk office. Now, when you look at the North American office market, both Canadian and U.S. office REIT companies suffer from the same fact that we're taking less office space, you know, as we go forward here, working at home or with the internet. But at the same point in time, Canada doesn't have the sort of hyper-economic growth markets like San Francisco, like Dallas, as viewers heard me chat with Rob Kaplan of the Dallas Fed a couple of weeks ago. So my sense is the U.S. market is like okay, but here in Canada, not having those hyper-growth markets, the office market in Canada, not that great?
Well, you made the point. We're going through a secular change. We're taking less and less office space. So if you built a building 20 years ago with 300 square feet per worker, today it's more like 150, 200. So right from the start, you're standing still in terms of delivering new space to the market. You're correct. It's hard to say the Canadian economy is more robust than the U.S. at this juncture. And when you talk about Canadian office markets, you're really talking about a handful. We can talk about Calgary. That used to be the tightest market in North America, and today, arguably, it's 40 to 45% vacant if you include sublease space. So let's talk about Toronto. Toronto has had tremendous headlines. You hear about what a tight market it is, and we've been surprised to its resilience. But if you actually drill down, you would find that a lot of the absorption that's happened in the Toronto market has actually happened in the South Core. In the traditional downtown financial center, you actually have had the same amount of square feet occupied by tenants in 2011 as you do today. So
for viewers who aren't from Toronto, by south of Core, you mean below Union Station? Correct, and that's been an exciting office market. And if you think about what drives new office buildings, people want brand new buildings. They want efficient space that's both clean air as well as the ability to really cram in a lot of people with the appropriate ratios to bathrooms, et cetera. And you can get that in the South Core today. So it sounds like if I were to look at your portfolio, I'm not going to find you owning many office REITs in Canada. Fair comment? We focus on supply and demand. You look at the supply picture in Toronto, you've had 6 million square feet delivered since 2011. You've got 6 million square feet under construction today. That's 55% leased. You have another 9 million square feet coming in the shadow pipeline if they get leases. That would equate to over 20% of the current stock. And that's on a base of, call it, 75 million square feet. Roughly speaking. Fair game. Okay. Well, when we showed our viewers the table earlier of performance of REITs, industrials have been smoking it this year. And that applies to Canada, too. Yeah. Oh, this is the best theme for us. Huge secular change. Whereas retail has its challenges, e-commerce has been a boon to industrial warehouse. For every square foot that a traditional brick-and-mortar retailer needs in warehouse space, they need 3 square feet of warehouse space for an e-commerce tenant. And if you think about why, a traditional brick-and-mortar retailer has their goods arrive in pallets. They're stacked up 32 feet high in a warehouse, and they go in and out. But in today's e-commerce driven arena, you need to have parcels. So you need a lot of space. They're not going to be stacked up high. You need the ability to go package them, so you need room to package, as well as you need the ability to return. So that's one aspect of it. The other thing is that the holy grail in today's retail supply chain is the last mile. Mm-hmm. We want to get those goods as quick as possible. For the 3PLs, for the transportation providers, they want to cut costs. By 3PLs, you mean third-party logistic companies? Correct. Okay. The FedExes, Canada Posts of the world. Right. So what does that mean? They need to get as close to the consumer as possible. So you have a whole new supply chain. And if you think about their P&L, their expenses, so 70% of their costs are transportation, 20% is labor, 5 to 7% is rent. If I can cut my transportation costs by 10%, I can double my rents. That's not lost on industrial landlords. So what do you like? We like 2 companies in the United States, and they're global players, Prologis. They're the largest player by far. I mean, they lease over 40 million square feet a quarter. They're under-rented by 12%, meaning their rents are below market. They're 97% occupied. A traditional landlord-tenant market is 92, 93. Mm-hmm. They have the ability to raise rents from here to 2019 and still be under market and deliver 3 to 4% NOI growth. Anything in Canada? Pure Industrial REIT. This is a great company. 30% of their tenants stem from e-commerce. The industrial markets here in Toronto are finally seeing the strength that you hadn't seen heretofore, and they have their largest presence here in Toronto. Now, when you move into the healthcare sector, the retirement home sector,
That's a space that has good fundamental outlook.
And that's been the case forever, frankly. We've all known about the aging baby boomer demographic. It's finally arrived. As real estate investors, that's one half of the equation, the demand side. You have to focus on supply. We've gone through the overbuilding of the 2000s. Right now, a company like Chartwell and a company like Sienna, they're both sitting in great positions as market leaders, both on the retirement side as well as the nursing home side.
And with respect to the cap rates, which of course is the inverse of the cash flow multiple on these stocks, they have higher cap rates than, say, another company like a CT REIT, which is Canadian Tire, or Choice Properties with his Loblaws, which my wife always beats me up because she bought them in her personal account a couple of years ago and has done really well on it. Mm-hmm. They're a single tenant landlord. They have lower cap rates than these nursing home companies, say a Sienna, where the guy that pays their bills has a AA credit rating.
Exactly. The Ontario government is the ultimate payer of these nursing homes. Institutions have a very tough time wrapping their heads around these spaces. So what was traditionally an 8% cap rate world for nursing homes, or even up to 10%, we would argue is 7% in Ontario, less in Vancouver. Similarly, with assisted living and retirement homes, everyone thought it was a 7% cap rate world. Today, we've seen transactions, Amica being taken private below 5%. Us at Vision, we're very happy to take a long-term view and say, well, institutions will catch up when they realize the value that can be created in this space.
And when you look at the capacity, the operating rate of the companies like Sienna, Chartwell, do they have lots of fundamental running room? Because when you look at the demographics and hence the potential demand over the next 5 years, is the operating rate so high that there has to be more homes built? And these guys are obvious players to do it?
Well, here's the issue in real estate, supply and demand. You have to have the supply, the lots available to create this real estate. We focus a lot on what are the right markets to be in. It's very difficult to pencil out returns today, ground-up development in some of these urban infill centers. Chartwell has the sites. More importantly, this is a very operationally intensive business. They are a great management team, and they're able to bring different ideas and different operating models to their properties. For example, Quebec has always had an a la carte model, where you as a senior can go and choose what services you want. In Ontario, we don't have that. We have a bit of a sticker shock. Wow, that's how much it costs for me to stay in a retirement residence. Well, they're bringing that a la carte model to Ontario.
Thanks very much, Andrew. So you heard it from Andrew Moffs of Vision Capital. He's interested in the odd A-mall REIT. He likes seniors living. He likes industrial. Not the biggest fan of office.